Hello and welcome to Market Square, where the latest news meets sharp insights. Today, we dive deep into how President Trump's policy are reshaping Nigerians' place in the global landscape, the battle eating up in the Nigerian fuel sector as Dangote faces fierce competition. We'll also explore how the Naira finds a bit of stability with the CBN's new moves. Stay tuned as we unpack this biggest market shift in today's episode. Welcome back to Market Square. Let's dive straight into today's key stories. President Donald Trump's second term brings a renewed push for these American-first policies, emphasizes economic nationalism, energy self-reliance, and pragmatic international relations. These strategies carry significant implications for Nigeria, Africa's largest economy, influencing key areas such as trade, energy partnership, diplomatic ties, immigration policies, and cultural collaboration. Now let's talk about how President Trump's policies are reshaping Nigeria's strategic landscape. In the past, trade between Nigeria and the US was largely fueled by oil exports, but the dynamic has shifted with Trump's push for energy independence and increased shale oil production. The US no longer relies on Nigerian crude oil the way it used to. Beyond oil, Nigeria's non-oil exports like cocoa, rubber, and textiles face hurdles due to stricter US import standards and trade restrictive policies. Even the African Growth and Opportunity Act, which offers duty-free access to US markets, could face renegotiation under the Trump's trade agenda. But it's not all a challenge. Nigerians have opportunity to boost agriculture exports, process cocoa and cashew nuts by meeting US standards. Plus, the African Continental Free Trade Areas offers Nigerians the chance to attract US manufacturers looking for affordable production hubs with regional market access. Another thing is energy remains the cornerstone of Nigerians' US relations. While the Trump's policy favors US energy independence, they also create opportunities for Nigeria to partner with American firms in oil, gas, and emerging renewable energy projects. Nigerian vast natural gas reserves position it as a potential supplier to global LNG markets. US investment in gas infrastructure could also accelerate Nigeria's transition from oil dependency. Then there is diplomacy. Nigeria's role as a regional power makes it a key US ally in counter-terrorism and stability efforts. But Trump's transactional approach to diplomacy means Nigeria has to prove its strategic value to keep military and development aid flowing. The US has provided Nigeria with military support in its fight against Boko Haram. However, Trump's administration will impose stricter conditions on aid, requiring transparency and alignment with broader US interests, such as countering Chinese influence in Africa. Immigration policy are also in play. Trump's stance on immigration and trade has implications for Nigerian diaspora and foreign direct investment. The administration restrictive immigration policies may impact remittance from Nigerians living in the US, which are a vital source of foreign exchange for the countries, but restrictive visas rules could reduce the vital inflow. However, it's a chance for Nigerians to create domestic opportunities and stem brain drain. Nigerians' cultural export like Nollywood films and Afrobeat offers a powerful avenue to enhance its global influence collaborations with US platforms, and artists can further elevate Nigerian soft power on the world stage. Trump policy presents a mix of hurdles and opportunity. Nigeria has a chance to innovate, diversify, and strengthen its position as a resilient global player. It's not just about navigating these obstacles, it's about transforming them into powerful catalysts for growth, enabling Nigerians to rise as a more resilient, forward-thinking global player. The future is not defined by adversity, but by how Nigerians seize this opportunity to evolve and lead. Now we move to the second headline. The Nigerian fuel market is experiencing a significant shift as oil marketers consider bypassing Dangote Petroleum Refinery's products in favor of a cheaper imported petroleum. This decision stems from a recent reduction in the landing cost of imported premium motor spirits, which now stands at 922.65 naira per litre compared to the 955 naira per litre offered by the Dangote Refinery. The price drop is influenced by factors such as shipping, import duties, and exchange rates. Experts believe that this lower cost gives marketers a strong incentive in source products internationally, particularly when profitability and competitive pricing are at stake. These trends provide private depot owners and independent marketers an opportunity to source fuel at reduced cost, thereby improving their margins. While these importers benefit from ex-depot prices of 950 naira to 990 naira per litre, retail prices remain high, hovering between 990 naira and 110 naira per litre in Abuja. This reveals deeper challenges including exchange rate volatility and global market pressure, leaving Nigerian consumers stuck with inflated fuel prices. This development raises concerns about the sustainability of the government's earlier agreements with industry stakeholders to prioritize locally refined products. The national president of the Petroleum Products Retail Outlet Owners Association of Nigeria expressed surprise at the resumed importation of petroleum, noting that the stakeholders had agreed to suspend imports for 180 days to allow Dangote Refinery to scale up production. Several challenges and risks could also impact the Nigerian fuel market, fluctuation in the global oil prices, changes in US monetary policy, and geopolitical tensions can affect Nigerians' foreign exchange earnings, and consequently, the stability of fuel prices. High inflation rates can also erode the purchasing power of consumers and create pressure on the exchange rates. Nigeria's economy faces structural challenges, including inadequate infrastructure, corruption, and reliance on oil revenues. Addressing these issues is also essential for long-term economic stability and a more resilient fuel market. The Nigerian government and industry stakeholders must continue to implement sound economic policy and reforms to sustain the stability of the fuel market. Key areas of focus should include dependency on oil revenues, promoting non-oil sectors such as agriculture, manufacturing, and technology. Improving infrastructure to support economic growth and attract foreign direct investment is also crucial. Enhancing transparency, accountability, and governance will also build investor confidence and foster a more stable economic environment. But the big question is how Dangote Refinery will respond. Will it reduce prices, improve efficiency, or scale up production to remain competitive? Experts believe that Dangote Refinery might need to revise its pricing strategy to align more closely with the international landing costs, making its products more attractive to marketers. Another thing is ramping up production to achieve economies of scale could help lower its costs and improve competitive standing. Another option could be leveraging government support to ensure its products remain a priority in the local market. The potential shift of oil marketers from Dangote fuel to cheaper imported petrol highlights the complexity of Nigeria's fuel market, while the lower landing cost of imported petrol presents an opportunity for profitability. It also underscores the need for continued reforms and strategic investment to ensure long-term sustainability and growth. For now, the Nigerian fuel market remains in a state of flux. The choices made by the local refineries, marketers, and the government in the coming weeks will determine whether the imported petroleum continues to dominate or if locally refined products can regain their prominence. Now we move to the third headline. The Nigerian naira has maintained its value in the unofficial market, trading at 1,640 naira to 1,650 naira per US dollar. This sustainability comes amid significant reforms in Nigeria's foreign exchange market, spearheaded by the Central Bank of Nigeria. The Apex Bank announced the introduction of the Nigerian's Foreign Exchange Code, a comprehensive set of guidelines designed to enhance the integrity and efficiency of the country's wholesale foreign exchange markets. The FX Code is based on the principles from the Global FX Code and incorporates best practices from leading financial markets worldwide. CBN's move aims to address the risks that have emerged from the positive transformation in Nigeria's financial landscape. The FX Code is structured around 6 core principles: ethics, governance, execution, information sharing, risk management and compliance, confirmation, and settlement processes. These principles are intended to promote a fair, liquid, and transparent FX market, ensuring that transactions are conducted at competitive prices aligned with the global standards. The introduction of the FX Code is expected to improve market performance and also strengthen Nigeria's flexibility exchange rates. It will also support diverse market participants, including authorized dealers, banks, and also financial institutions in conducting their operations more efficiently and transparently. In addition to the FX Code, the naira stability has also strengthened by several factors. The Dangote Refinery's input has reduced the need for oil imports, and an uptick in Nigeria's oil production has provided a steady stream of foreign exchange. Nigeria produced an average of 1.5 million barrels of oil per day last month, an improvement from the previous month. The implementation of the electronic foreign exchange market system has made information more accessible to investors and businesses, easing pressures on the FX market. The CBN's effort to enhance transparency and market efficiency has also contributed to the recent calmness in the naira's value. But despite the relative stability, several challenges and risks could also impact the naira's performance. Fluctuation in the global market, change in US monetary policy, and geopolitical tensions can affect Nigeria's foreign exchange earnings and consequently the naira's stability. High inflation rates can also erode purchasing power of the naira and create pressures on the exchange rates. The CBN must balance its efforts to control inflation with the need to support economic growth. Additionally, Nigeria's economy faces structural challenges, including inadequate infrastructure, corruption, and a reliance on oil revenues. Addressing these issues is essential for long-term economic stability and a resilient naira. But looking ahead, the Nigerian government and the CBN must continue to implement sound economic policy and reforms to sustain naira stability. Key areas of focus should include reducing dependency on oil revenues, promoting non-oil sectors such as agriculture, manufacturing, and technology, improving infrastructure to support economic growth and attract foreign direct investment is also very important. The Naira's price stability in unofficial markets and introduction of the FX code by the CBN are positive developments for Nigeria's foreign exchange market. These measures are expected to enhance market integrity, improve transparency, and support the country's flexible exchange rate system. As the CBN continues to implement reforms, it's crucial to address the underlying risks to sustain the Naira's stability and support Nigerians' economic growth. Now we move to the fourth headline, which is the last headline. The Monetary Policy Committee of the Bank of Ghana has announced the decision to keep the policy rate unchanged at 27%. This decision comes amid ongoing rising inflation in the global economic environment. Governor Dr. Ernest Addison explained that the decision reflects the bank's cautious approach as inflation remains elevated despite efforts to control it. Ghana closed 2024 with an end-year inflation rate at 23.8%, significantly missing its target of 15%. December's inflation marked the highest in 8 months, driven primarily by rising food prices. To give you a better understanding of the situation, we have a video breaking down the factors behind the inflation. Take a listen.
The inflation profile remains elevated, largely driven by food price movements, especially in the last quarter of the year. The climate-related factors, including the dry spell in some parts of the food-growing regions of the country, and the late onset of rains negatively affected production, while supply chain weaknesses generally affected food prices. While the inflation outturn for the year 2024 deviated from target, it is expected that the disinflation process will resume, contingent on renewed efforts at fiscal consolidation, which is anticipated in the new administration's economic policy agenda and the yet-to-be-presented 2025 budget statement. The bank's latest inflation forecast shows a steady decline and return to the path of disinflation with an extended time horizon of achieving the medium-term target of 8 plus or minus 2%. Under the circumstances, the committee decided to keep the monetary policy rate unchanged at 27%.
The Bank of Ghana remains optimistic about resuming the disinflation process on renewed effort at the fiscal consolidation. The cautious stance taken by the MPC reflects the bank's commitment to managing inflation. The decision to hold the policy rate at 27% underscored the challenges faced by the Bank of Ghana in tackling persistent inflation. While the path to achieving the inflation target may be longer than anticipated, the bank's commitment to fiscal discipline and macroeconomic stability remains steadfast. That brings us to the end of today's episode. From Trump's game-changing policy to the fuel price shakeup and the Naira's latest moves, it is clear that markets are in motion. Stay tuned, stay ahead, and join us next time for more market trends, global news, and expert analysis. I'm Olaiton Adebayo. See you in the next one.